strategies and talk about just in general terms, what strategy do I use and really when might I want to use that strategy. I'll talk a little bit more about like the ratio butterfly. Let's start let's start with some generalizations about the S&P. Okay, so here we have the SPX and a expected moves, which is exactly what I want to reference. So these expected moves over here, obviously higher or lower. And what's great though is in this conversation of what strategy do I use, kind of and when, we'll look at the current market environment and we'll say, well, all right, well, this is where the week ultimately started. We rallied back up just shy of the expected move. We're kind of coming back down a little bit today, neither here nor there. But again, right here at 2460 is the upper end of the expected move. So when we talk about like what strategy, when, why, we also have to define time frame. Okay, so if you look at like a longer duration time frame, there's not that many strategies for long duration. Buy a stock and hold it, or short a stock and hold it. You know, if you're Bill Ackman out there, you're short forever. But in the shorter time frame, when I start looking at stuff like on a week-to-week basis, that's when strategies and first like the tetrapod spread come in. I still want to be a seller of premium. Like, listen, my entire trading career pretty much revolved around selling options premium. It's what I know and it's where I've lived for an extremely long time. But when looking at markets over the past few years, there's, some real abundant things that stand out. And I've talked about this before, but it actually helps define what strategy and why. There have been these vast periods of nothingness. Okay, and I'm actually pointing out the nothingness, which when I say vast periods, even the rally over here, this was still, for the most part, that was priced in. That was not priced in. Vast periods, okay, of nothingness, followed by wild, inexplicably large, what we term 3 sigma moves, like over here, back in that neighborhood, right over here. That was, if you want to look December 7th, okay, December 7th, and that was just 2016. That's one of the most recent 3 sigma moves over here. So vast periods of nothingness followed by wild moves. So one of the first things that I think about when I'm coming into a strategy, sure, I want to go out and I want to sell options premium. But the problem with selling options premium is, again, you might make money, 10 times in a row over here. You'll barf it all back up in one bad day over here. And then, you'll make it again right there, and you'll barf it all back up right in this neighborhood. And then you'll make, 10 times your money here. One of the issues in recent trading that we've seen is that premium selling alone isn't really working unless you've got some type of a hedging strategy to it. And that's why we've actually used this, this tetrapod spread, which if you've done one or two, you're not having great results over here. It's got to be like all premium selling. You have to be deadly consistent. And you're just like, okay, I'm doing it and I'm doing it and I'm doing it and I'm doing it. Right. And that's not easy for some people. And it's again, looking at the day-to-day moves really torment people. By the way, if looking at the day-to-day moves and something like a tetrapod spread bother you, it'll actually tell you something about your threshold for risk. Because the tetrapod, it's nothing more than like an iron condor. Okay. Yes, I buy a hedge, but it's nothing more than like an iron condor over there. So the first thing I will mention is this tetrapod spread, which effectively can be placed in, relatively speaking, almost any marketplace. How's it doing today? Well, if the S&P's back off a little bit, just a little bit today, this thing will be actually sitting beautifully, right? We would need the NASDAQ down a bit more, and I don't think I'm looking for an exit of the tetrapod today, but by tomorrow, absolutely. Tomorrow's already Thursday, gonna have to. So the tetrapod spread deals a lot with the expected moves over there. Now, to continue on, what other kind of strategies would I think about? Well, we just covered recently in a class this ratio butterfly idea, okay? Neither here nor there. I'm going to shelf that for just a second, okay? Looking on a week-to-week basis, one of the strategies that I use on a week-to-week basis, if we come to the upper end of an expected move, and by the way, we could spend no less than a week discussing this topic. This is like one of the most in-depth topics, is like, So what strategy do I use and when do I use it, right? So one of the other strategies I think about on a week-to-week basis. So the tetrapod that you know suits for a week. One of the other things I think about when we come to the upper edge of an expected move, like if we came right up here to the edge of this expected move, I would actually put on a ratio back spread. And the ratio back spread over here would be, and I'll just give you an actual example of it. It'd be sell, okay, one of like a 2460, and for instance, buy two of the, let's call it, 2470s. So I'd back spread it in case we came right to the edge of the expected move and we exploded higher. If we got like one of these 3 sigma moves, this is the right strategy for the upper edge of the expected move. Okay. By the way, I'm going to be doing a class on ratio back spreads. I do believe that's going to be my September class. So I'm letting the cat out of the bag a little bit over there because there's a lot of different uses for a ratio back spread. One of the best uses for ratio's back spread is actually when the markets are falling hard. When markets are falling hard and I'm bearish, I will actually put on ratio back spreads to hedge the pops to the upside. Because what do you get? In a bearish marketplace, you get these wild bursts to the upside. And the wild burst to the upside, if you're short, will take your head right off your shoulders. So why not ratio back spread? When you're falling hard, you're like, yeah, all the way down. Hedge off risk, hedge off risk, hedge off risk by the ratio back spreads. It's good, eh? Okay, lets you stay short too. Anyway, I hope that helps a little. By the way, I've done some discussions on the ratio back spread, but I'm going to put together a full-blown class on it. I've never done that. It will be a first. It will be a first. I've used the ratio back spread. There's a lot of uses for the ratio back spread, but it'll be the first class that I do on the ratio back spread. Yeah, it's a bullish strategy. Right, it's got calls in it. No crap, Brian. Yeah, it's got calls. You're not the right Brian. You're a different Brian. There's multiple Brians. Imagine that. Okay? There's only like 100 names used in the world. Well, in the world that we know here in the U.S., we're an isolated bunch. Anyway, there's only like 100 names used. How many Brians do we have? We're running out of Brians! Okay. Yeah, let's see if the NQ dies. Hold on, I got to look at the S&Ps here. Look at this. If you think the S&Ps are going to come off, the XLF disagrees with you. Completely disagrees with you. Go Amazon. There's nothing better for, like, I don't know why. I just got to root for Bezos, though, to lose. I don't know why. It has nothing to do with being a billionaire over there. It's just, he was selling books for a loss 15, 20 years ago. Now, okay, now I feel like I have to actually bow down, and I don't like it. I had an Amazon guy come to the house last night, like 8:30 at night for a delivery. I totally forgot about it. It was like same day delivery, and because I'm actually catching a flight today, and he came to the house like 8:30 at night, and I rings the doorbell and I pick it up on the phone and I'm like, hello, Amazon. Wow, they're everywhere, people. Anyway, if you take a look at the XLF, it's not agreeing in the sell side activity, but there's still a chance we sell off today. So I wanted to start with just some thoughts there in the SPX, in the expected move. I think it's a good place for starting. So these week-to-week basis, also don't let it fall by the wayside. On a week-to-week basis, you could be plotting and planning and using butterflies around expected moves. There's a lot of strategies that we've gone over. A lot of strategies that we've gone over here at Theo Trade. And some of the accounts are like, a little smaller. I want to grow my account. I would consider the butterflies a smaller account, growing the account. One of the questions that I often get, by the way, the bonds are at highs of the day. One of the questions I often get is they say, well, you'll do a class, and sometimes you trade them and sometimes you don't. Well, again, to be completely forthright with you, and I try to be completely forthright. Like, I don't mind showing, like, this is my account, that's one of them. Here's another account. I mean, I show you some of the crappiest positions I've got on, and I actually enjoy doing it because it keeps you honest. Like, most people that show accounts are like, hey, look, Don is down 30% on FedEx. You can't suck any more than that, okay? Most people show you, I made $1 million over here. No, they don't. You can make $1 million, but I'll tell you what, the buck kind of stops here. I watched people's accounts for 15 years straight. Anybody that says they're making like millions in markets, I have a lot of capital in my account. You ain't gonna make any millions, okay, unless you have serious, serious capital to trade with out there. You can make a decent living trading, but delusions of grandeur, put them aside. I hope I make that clear very often. Anyway, where I was going with this is certain strategies you won't see a lot in my account. They're not big enough to be impactful to me. And I think in the future I will try to do a better job of, like, after I do a class like butterflies around expected moves, I didn't necessarily place a lot of butterflies over there, but it's not because they don't work or this works or that doesn't work. Okay, actually the butterflies around expected moves are pretty effective because we keep edging right to the expected move. It's that for me, it doesn't do enough damage profit and loss wise. Like I have and do trade, if I don't see about 5 grand of P&L every single day, I'm doing something wrong. And I don't necessarily want to jump out and do a butterfly because it's going to be, $50 in commissions on either side of it. So I have to trade a little bit more size, use futures contracts and so forth. It just, again, it depends on the strategy over there. So sorry, I'm reading back over here in the chat room. All right. My wife and I were fighting the other day, and Alexa ordered us boxing gloves. Are you serious? That's hysterical. By the way, there was a murder that took place. Like, no laughing matter, a murder took place, and Alexa did have recordings of it in the background. As of right now, I'm not sure Amazon has released it, but even the initial suspect, I haven't looked at the case in a while. The initial suspect, though, said, yes, you can relinquish the tapes. It would probably prove his innocence. I think that stuff's amazing, okay, of how many listening devices you possibly have in your house. Yeah, be careful what you do, all right? By the way, poolside trader, I love it. My wife and I were fighting the other day. Nobody ever says that. Oh, my wife and I were fighting. Well, here in my house, I just basically take a beating. I'll just lay down, curl in a ball, take a beating. She's a vicious 100 pounds. Vicious. Nobody believes me. All right? If you come to Scottsdale, I will literally bring the vicious, to you. So it's like 100 pounds of mean. Oh, it's very scary. Anyway, if I had Alexa, which I don't, she would know. Alexa would know. It's a she. It has to be a she. Anyway, on and up to other strategies over here. So we talked a little bit about, the idea of like week-to-week strategy in using around expected moves. But let's go to a larger sense for a second, then we'll cover some of the shorter term stuff. In a larger sense, by the way, the XLF is coming back off. It is reacting a little bit to the bonds breaking higher. What can you do in a larger sense? Okay, in a larger sense, long and short positions. Okay, I look, and again, what strategy do I use and when? I look at this over the last 3 years. Okay, and I'll tell you, I wake up every day and I do read a lot of the news out there. Now, I don't necessarily read, and I'll make this clear. When I say I read a lot of news, I don't turn on CNBC ever. Okay, legitimately, if I've watched CNBC, it's in passing. It's on like my gym or something. I don't. Okay, I definitely don't watch any of the financial media out there whatsoever. The reading that I do is predominantly, and I try to make it as factual based as possible. And that doesn't sound like easy to do. It's actually not. I will read some of the news. Like, if you guys are curious what news services I use, I'll actually read some of the news right here on Thinkorswim. I'll type in like /ES, and I'll actually read some of the news in here. Because again, people always ask me this, and for what strategy I use and why. I mean, this fits into it. So, if I detach the gadget, I'll just show you. I like some of the news in here. The reason I like some of the news, and I think Jeff Bierman would probably agree with me, is over the years at Thinkorswim, we got to select what news feeds went in here. And most of the news feeds in here, there are some that are definitely biased, but a lot of the news feeds that are in here, ultimately, they just tell like whatever's going on. That's it. It's like literally like a blurb. This is a fun one. Here's a story. Okay. Herbalife 600 million stock buyback, reduced the number of shares available for short. Anyway, this is a lot of the stuff in here is more like factual kind of based. And the reason I trust the news in here, not only because I, put some of the news services in here myself, literally, it's the brokerage firms don't want big bias in their news stories out there. It's kind of fun. Anyway, that's a lot of what I will. That's a lot of what I will use. Somebody's saying, why is IBM up? Okay, because it's had the crap beaten out of it. Why is Ford up too? Seriously. Okay. Oh, see, Kramer, stop. This is the stuff that I will never, I'll never look at ever. Like I don't listen to necessarily any individuals. I do look at some of the commentary once in a while. A few buddies of mine that have been in the business for a long time. Anyway, that's so on a longer sense. Okay, I look at markets over a couple of years, and I'll think to myself, all right, I want a long duration, short position or long position, vice versa. For me, I will predominantly use futures to take those positions. I'm short 2 S&Ps, short 3, but that stuff's pretty easy. Now, let's get into the most difficult time frame. The most difficult time frame, look at a stock like Google. Okay? The most difficult time frame for people to assess different strategies, option strategies, specifically around individual stocks. It's the option strategies for like a month or an option strategy for like 3 weeks. Now, again, if you no idea what I'm talking about right now, we did a class back, I think it was in the November time frame, and it was a class that basically talked about time frame, expected move. It filled a lot of these gaps in here, and what it had to do, one of the aspects in the class, we talked about three definitive time frames. So one of the things you do, number one, we talked about intraday, right? Those are the people that are in and out in one day. Number two was we kind of called mid duration. It's really hard to write on this screen. Okay, there was mid duration, and then of course we had duration. Duration, what's duration? That's just long and short stock. That's it, or long and short futures. That's the bigger, 3-year picture that I was just looking at. Great. That one's easy. You're just long or you're short. You could use synthetics over there. You could buy an in-the-money put if you want to be bearish. You could buy a deep-in-the-money call if you want to be bullish. So check. Intraday. We're not really going to cover intraday because intraday, sure, you know what to do. You get long, you get short, you trade NASDAQ futures, okay? The one that is undoubtedly the most difficult is this mid-duration. I'm going to be just totally forthright over here. Intraday, you strategize. We had a couple of different classes. I've done classes on intraday. Jeff Bierman's actually talked about intraday setups, and Tony Rego has most definitively talked about it because he talks about intraday every single day. Duration, we've absolutely covered. Okay, what do I like? I like Ford. It's up. Great. Okay, done. Mid-duration. Mid-duration is the hardest thing. These are your option strategies. Now, when I said I wanted to be totally forthright, that mid-duration, what it really spans for is anything from a few days, okay, up to about 3 months out. That's what I consider these mid-duration. And this includes like irons, all different types of flies. What else you got? Okay, tetra, okay, irons, flies, tetra, in-outs. It all comes into this mid-duration. The reason I'm actually saying, like, let me be forthright, mid-duration to me right now, mid-duration I think is the most difficult to discern. It's the most difficult to discern because the markets right now, they're not exactly throwing you a lot of softballs out there. The market right now is extremely difficult to discern as to what's going on. Okay? Like today is no different. Like you're looking at the XLF, you're like, what the hell? The XLF is flat, the bonds are up huge, and the market's down. I don't get it. Neither do I. That's great. But that mid-duration over here, it's no easy task because you're looking at a product like the spiders, and the spiders lately, like, they're going so up that they fell down, that they had to rally, and then they're selling back off. Okay? When you're looking for strategies on a day-to-day basis, you look at something like Google, you're like, well, what should I do? Okay? Here's how you answer that question. First of all, what do you want to do in Google? Okay, what do you want to do in Google? Because let's break down this mid duration to what it is. What is the mid duration? Okay, the mid duration, you have basically only a handful of things that you can do in that mid duration. Okay, you can get bullish, you can get bearish, okay, or you can get neutral. This means neutral. We'll call it neutral short, and this, I'll call it, is neutral long. I'm making symbols up now. And the only reason I'm saying this is because you think we're going to stay inside the expected move, and this is you think we're going to go outside the expected move. So if Google's supposed to move up or down X amount, I could either sell premium or I could buy premium, right? That's it. There's only like, what, 1, 2, 3, 4 different things that can actually happen. You're either neutral long, neutral short, bullish, or bearish. So I guess when you're approaching something like Google, what do you want to approach it with? As I mentioned yesterday, I want to approach it, and I'm telling you, definitively, I want to be bearish in here. And if I want to be bearish, okay, I don't, cut through all the noise. Like, do I want to sell some premium? Well, if I want to sell some premium, the IV percentile's got to be jacked up, and it isn't. It's at 40%. So I turn around and say, screw it, I'm not going to sell premium in here. It's just not there for me, okay? And I really think the stock could actually break down heavily, so I want to create a definitive bearish position. How do I do it? That's probably when I'm going to run to the in-out spread. That's it. That's my thought process, okay? There's your bearish trade on Google. Next! Okay, let's go on to Alibaba. Baba! Where is it? Alibaba. All right, so if I look at Baba, I have wanted, this might be the reversal candle today. I have wanted to short this thing with both hands, but I have a rule. I wait till at least 1, 2, 3, 4, about 5 days after. After what? After the earnings. Got to wait till at least 5 days after the earnings. And I got to tell you, I'm the biggest violator of my own rule. Sometimes I don't wait, and I'm like, that was so friggin' stupid. I do stupid things all the time, okay? Stupid things all the time. By the way, trading, it's not about being right or wrong. It's limiting your own stupidity. It's you against your own stupidity. My wife reminds me of this. It's good, all right? If you're not married, you don't have anybody to keep you grounded, right? Where's the other Brian? The other Brian in here? I think he's a single guy. You got nobody to ground you. Brian, you suck. Don't do stupid things. I'm just trying to help you out, buddy. Just trying to help you out. People get into trading psychology. Forget that. Just have somebody once a day be like, you're such an idiot. And then you realize, you're like, yes, I do stupid things in the marketplace. No? Nobody else? Wow. I'm all alone in this one, huh? So, yes. And, gentlemen, you can't have the wife that's just like rah, rah. You have to have the wife that's like, oh, you're an idiot. Anybody that's been married for more than 5 years, yes, you probably are on that picture. No? But in all seriousness, you do have to stay grounded in trading, because once you think you realize something, you're like, no, you're probably going to end up into the stupid traps that we all end up in. Anyway, Elvis, all right? Brian. Oh, come on, Brian. I was trying to help you out, buddy. Ron, you're a pilot. Yeah, hopefully you're saying to that yourself. As Ron is a pilot, hopefully he says, I'm not going to do stupid things during this flight. I got to go fly later today. Anyway, in something like Baba, all right, apparently I'm on my own with that one. Yeah. Oh, the other Don over here has been married for 50 years. Well, that means, Don, you gave up about 45 years back. Threw in the towel. Anyway, when you look at something like Baba, this is an extremely aggressive upside. Okay? It's an extremely aggressive trade, and an extremely aggressive trade. And what's aggressive about it? Okay, I'm thinking about getting bearish in here because this fits a lot of the criteria that I look for to be able to get bearish. So the day is stupid. It's not me. Trust me, it's you. No, nobody likes being called stupid. It's okay. In trading, it will help you. I am telling you, I'm living proof of that. Anyway, I got a rant going on in like the chat room over there. I got rid of my stupid thing. Now it's me. All right. Amen to that one. I love it. So that didn't even occur to me. So that right there is the comment of the day. Forget everything else up until this up until this point. That right there is the funniest thing we've actually heard all day long. This is an extremely aggressive upside inside of Alibaba. Okay, I will look at implied volatility percentiles in Alibaba. It's at the 50th percentile. Now, I'm going to give you kind of my own insight, like how I'll actually look at this. I can approach Alibaba with selling out of the money premium. I can do it, but I'm bothered by one reality. Alibaba has made an explosive move to the upside. And if I sell this $5 wide spread, I can sell it right now for like a buck 30. At the same time, okay, the way that I have tendency to want to approach this, I'll have much more tendency, and I'm going to bring up both of them. I might look at these two trades, and literally what we have here is, by the way, they're the same in respect to direction. I've made directional bias very much tertiary. Okay, it's the third thing down the line. It might be the reason that I want to do a trade, okay, but it's not going to define my reasoning behind the trade. I hope that makes sense. You know, yeah, I look at Alibaba and I think, okay, it's making this explosive up move. These are the kind of moves I love to stand in front of, but that's not going to define why I'm doing the trade. Here we have various positions. Now, I didn't need to make a $5 wide spread, but from a risk reward standpoint, here I've got basically 370 at risk, right, in this strategy. Over here, I just have a buck 25 at risk. Now, the 370 at risk doesn't necessarily intimidate me. What intimidates me is when I'm standing in front of a freight train, okay, I don't want to put myself at 370 of risk. That's the point that I wanted to make. And by the way, this truly does look like a kind of a key reversal day inside of Alibaba. And if you're into key reversals and stuff, cool. If you're not, like whatever. That's something that like Jeff Bierman talks about all the time. This is the exact kind of reversal candle you would look for. Right now, it's a doji hammer. Doji hammer. Anyway, if you're standing in front of the freight train, okay, to me, I don't want to stand in front of the freight train with 370 of baggage on me. Like literally think of it like yourself with a giant backpack filled with crap on your back and you're standing in front of a freight train. It's not easy to get out of the way. The in-out spread, I'm not going to get out of the way because I only have very small mitigated losses in here. It's a buck 25. I like to stand in front of the freight train with small amounts of risk because it makes me feel impervious, okay, to what that thing is doing. And this is a freight train. And that's in the shorter duration. In this trade, once again, I am telling you I want to be bearish. I'm telling you I'm stepping in front of a freight train. And I'm telling you I would rather use an in-out spread. All right, let's move on. So different scenarios call for different strategies in here. Okay, moving along. Now, we talked a little bit about Facebook the other day. We've talked about a few underlyings. I talked about something like Caterpillar. Tell you what, cat's on the screen. Let me go use Caterpillar. Caterpillar seems to just kind of be range bound. Could it break the range? Yeah. But in this kind of range bound motion in stocks like this, this is where, yes, I will and I always do look at the IV percentile. Like I'll look at it. It's kind of low, but nevertheless, you know, it's to the upper end of the range it hit yesterday. Might be coming in a little bit. This is where I'll start to get a little bit more cutesy and use something like a ratio fly. Okay? It's fine. And like, why would I use ratio fly? Well, you know, I could even sell premium in here, but the IV percentile doesn't necessarily have to be high for me to sell premium. But the one thing I'm going to tell you, when I'm selling premium, at least right now, I don't want it to be in the middle of some wild like trend that stock is making. Okay, Caterpillar, right? To me, I'm bearish in Caterpillar, but I see it in like oscillating back and forth, yada yada yada. All I'm trying to do is, you know, all I'm trying to do over here is it oscillates up and down. I'm going to put the strategy on, which I got it on yesterday. Hopefully it comes in a little bit. I'll cover my short spread and be left with a butterfly, you know, and we'll see how it goes. That's it. That's Caterpillar. So every single scenario has its own, you know, kind of unique flavor to it. And people are going to judge these a little bit different. But there's not really, like, I want you to know something. There's like no going wrong in here. You've got the in-out spread. You could sell a spread. You could use a ratio fly. You know, you haven't seen me use much of iron condors because that's the tetrapod spread, and that seems to be okay inside of the index products. And I'll kind of move on. I was looking at Facebook and Apple a lot lately. By the way, the underlyings that you trade, Like, please, people like are all like, what underlying should I trade? Seriously? Just trade one of the liquid ones. Just okay, Microsoft, okay, Netflix, okay, Facebook, okay, Apple, Google, Amazon. The underlying you trade is like it doesn't really matter. Who cares as long as it's liquid? It's just a couple of letters with a volatility, and that's it. Do you really think? I mean, don't justify your mid duration trades. And again, mid duration, let's define it. Okay, mid duration days to about 3 months out. Don't dare justify this time period with what you think about Tesla. Nobody gives a crap what Tesla's going to do. Like, in terms of like valuation, you're like, well, the company is overvalued. Who cares? From a day to 3 months, that has no bearing whatsoever in terms of valuation of Tesla. Tesla's going to do whatever it's going to do in the next day to 3 months. I don't think that's going to have a lot to do with, well, they produced X amount of model, what the hell's the model now? Model S, Model X, okay, Model X, what Model S. We're just going through the alphabet. Model A, B, C, D. Anyway, it has no bearing on it. Apple, I'll give you an interesting one for Apple. Apple has a material announcement, we think somewhere here in September, because they're going to, it's a new phone. But that doesn't even impact the trade all that much. Anyway, I look at something like Apple similarly to the way that I looked at Caterpillar. It's kind of channeling a little bit. It's toward the upper end of the channel. Like if you want to get outright bearish, you're like, oh, I want to get bearish. Or, oh, I want to get bullish. Use an announced spread. But if you think it's going to stay in this channel, maybe break down a little bit, and maybe sell a spread. Then maybe go out there, use a ratio fly. Like, again, don't be, there's no need to get cute here. Like, there's no points for getting cute on what strategy you're going to use. This stuff it's not that difficult. In the end, and I always remind people of in the end, number one, limit the number of stupid things that you do. Number two, okay, hey, look, you got calls and you got puts. You could pretty much buy them or sell them. That's it. Everything else is a combination thereof. So come in there, look at Apple and tell me what you're thinking, and then build a strategy from whatever you're thinking. I'm mildly bearish. Well, if you're mildly bearish, then you can come maybe about 30 days out, come right down to that 33 delta, go over here and go buy, and we'll go unbalanced butterfly. Okay, well that one works. Hold on. There's too much junk in here. There's too much junk. I can't take it. So let me delete this out. When it comes to building trades, again, I'm a trade building machine. I can just build trades all day. Everything is tradable. I'm not saying everything makes money, but everything is tradable out there. I don't love this one. It's only for a 46-cent credit. Yuck, yuck. I like to a little bit more. Little bit more. Kind of curious about this 42 delta. The thing is about trading too, it doesn't always work out as perfectly as you thought it was going to be. I must use between a 30 and 40 delta. Well, guess what? There's a 33 delta and a 42 delta. Breathe deeply, because this might be the right trade. Anyway, here. This is a ratio fly inside of the Apple for 30 days. The Apple. And if the Apple breaks to the upside, the ratio fly is going to get crushed. Right? So, again, going through here. Oh, hang on one second. Oh, excuse me. All the yelling about myself being stupid got me all choked up over here. Has that conversation ended inside of the inside of the chat room over there? We're just reading back over here. Sorry. Looking. Sorry, I'm reading over here some of the comments. By the way, Brian, yes, if you read Zero Hedge will make you halfway through the day, you'll be like, that's it, I can't live anymore. This is a horrible world. That's Zero Hedge in a nutshell. That's their goal. I mean, by the way, I've known some of the guys at Zero Hedge, and their entire goal is to make the world sound as absolutely as horrific as possible. If you don't believe that, look at their main tagline. Given a long enough time frame, if the lifespan of everybody is zero, or the chances of living forever or something is zero. I can't remember what it is, but just you read that and you're like, oh yeah, this is not good. I'm going back to the S&Ps here for just a second because I do have to turn it over to Jeff Bierman in a minute. And quite frankly, I got to get out of here like on the second today, ultimately because I have a plane to catch in a relatively short period of time. So if you take a look, the Nasdaq ripped to the upside, hit 5,800. Sorry, 5850 and ripped through it obviously this morning, but coming up to this 60 level from earlier looked pretty stopped it like on a dime. It broke through it though this time. I'm just watching the Nasdaq futures earlier out of the corner of my eye, and 5860 looked like a pretty formidable level. One of the things that I'm also looking at as the remainder of the day. So the ticks in the S&P, they're getting a little bit better, but they're just not in full like ascent mode. There's just no question. This is a bit of an odd day. It's a day where we've had the XLF rally up. The bonds are still poised higher. Okay, that's unusual. The volatility futures, okay, listen, these things haven't dropped off. Why? You've seen the market now rally, excuse me, from the 38 handle, the market's rallied back to the 46 handle. So not been a huge rally in the S&Ps, but in that rally in the S&Ps, the volatility is not coming off. Now, bear with me because on the day, the market could start to rally, and yes, the volatility could fall off the edge of the earth over here. But for right now, I still think you have to be on your guard because we have bonds poised higher, volatility futures hanging in there relatively flat. Google started to rally, and that, and only that, has really driven. I mean, that's what's driving these Nasdaq futures. Strange, right? Okay. If you look at something like Facebook, right, got a little bit of a bit under it, but nothing in comparison to the action we just saw. The powers that be are still down 12 on the day, but definitely on the bid. And again, they look just to have stopped dead in their tracks. I still look at the advanced decline line. Okay, the day still has got quite a bit of risk ultimately left in it, and that's, I guess, like the overwhelming theme today for me is, could you take bullish trades? Without hesitation, yes. Okay, you can take bullish trades today. I will not do so, though, until I see something in terms either the bonds got to back off or the volatility's got to drop. Maybe I'll be too late to ever take a bullish trade, but I'm going to tell you right now, based on this tape, I will not get bullish in this environment today. Even for a matter of a few minutes, this scares me from a risk-reward standpoint. I don't like to see the volatility elevated and the bonds elevated when I'm going out there and buying S&Ps. Even if you bought S&Ps out of the gate this morning at the 41 level, you bought them at 41, you're at 46 right now. You're up 5 points. It's not enough. It's not enough for the quick, reversal that you can see on a day like this. The volume is, again, the volume is really dried up. There's just nobody trading this right now to the upside. And again, I warn you, the ticks, they're in ascent, but they're not exploding higher. Okay, the XLF it's strong. It's up 2 cents now today, but I'm still wanting more out of this. With that, I'm going to turn it over to Jeff Bierman. I've got to go catch a flight. I'll be on first thing tomorrow. I'll be broadcasting remotely. So today we've actually got Jeff Bierman. He's going to do a little bit of Q&A, so start firing some questions in. If you've got a technical analysis related question, he's got emails, but he'll also be reading the chat room. Stay tuned. Again, you've got Jeff Bierman coming up here in the third hour of Theo Trade. Tony will be on at 11 a.m. Pacific. Okay, Doc will be on the last hour of the day. Doc is also going to be on for the options happy hour this evening. Stay tuned, everybody. Again, Jeff Bierman coming on here in just about 1 minute. Thanks.